Hey everyone, welcome back to another episode of Financial Knowledge 101. Have you ever felt the excitement when the stock market is going up, thinking you might be missing out on big gains? Or, on the flip side, have you found yourself feeling uncertain when the market drops, unsure of how to respond? You're not alone. Understanding whether we're in a bull market or a bear market can make all the difference in your investment strategy. So today, we're going to break it down. What are bull and bear markets? What causes them? And how can you, as an investor, navigate these market conditions? By the end of this video, you'll have a clearer picture of these market trends, how they impact your investments, and most importantly, how you can respond effectively, no matter the market climate. So, let's dive in. What is a bull market versus a bear market? Let's start with the basics. What exactly do we mean by bull market and bear market? A bull market is when the market is on the rise. Think of it like a bull charging forward with its horns raised. In a bull market, asset prices generally go up, investor sentiment is positive, and buying activity is strong. This is typically seen during periods of economic growth, when companies are doing well, and investor confidence is high. On the other hand, a bear market is when the market is in decline. Imagine a bear slowly walking with its head down. This reflects a market where prices are falling, sentiment is negative, and investors are generally selling off their assets. A bear market usually happens when the economy is slowing down, corporate profits are falling, and confidence starts to wane. To put it simply, bull market equals uptrend, rising prices, optimism. Bear market equals downtrend, falling prices, pessimism. Understanding the difference between these two can help you identify the market trend and adjust your strategy accordingly. What causes bull and bear markets? So, what causes these market shifts? Why do we move from a bull market to a bear market, or vice versa? Let's take a look at some key drivers. First up, economic cycles. Bull markets typically emerge when the economy is recovering or expanding. Strong GDP growth, low unemployment, and rising corporate profits all contribute to a market that's moving upward. In contrast, bear markets usually arise when the economy starts to slow down, profits decline, and the outlook turns negative. Next, interest rates play a huge role. Low interest rates often stimulate borrowing, investment, and consumer spending, which helps fuel a bull market. But when interest rates rise, it can lead to a slowdown in economic activity, tightening up the market and triggering a bear market. Another factor is investor sentiment and expectations. During a bull market, investors are generally optimistic, believing that the future will be bright, and that the market will continue to rise. However, in a bear market, investors start to feel fearful or uncertain, leading to increased selling pressure as people try to cut their losses. Lastly, external events like financial crises, wars, natural disasters, or even major policy changes can dramatically affect market sentiment and trigger either a bull or bear market. Take, for example, the 2008 global financial crisis. This was a major catalyst for a bear market that affected economies worldwide. These factors all interact and create the conditions for either a bull or bear market. Understanding these causes can help you anticipate potential shifts in the market and plan your strategy accordingly. How bull and bear markets impact your wealth. Now that we've defined both markets and looked at what causes them, let's talk about how these market conditions impact your personal wealth. In a bull market, if you're able to get in early, invest in good assets, and ride the upward trend, you stand to make substantial returns. But it's important to remember that bull markets also come with risks. If you get too excited and buy in at the peak, hoping for even higher returns, you might be setting yourself up for disappointment when the market eventually corrects. In a bear market, while your investments may lose value in the short term, bear markets can also offer significant opportunities. Prices are generally lower, and buying quality assets at a discount can be a great strategy for long-term investors. If you have the patience and the capital to weather the storm, you could benefit from the eventual recovery when the market swings back to a bull trend. So, whether you're in a bull or bear market, The key is to stay calm and be strategic. Knowing how to protect your assets in a bull market and capitalize on opportunities in a bear market can help you build wealth over time. How to identify a bull market versus bear market. Alright. So how do you actually identify whether we're in a bull market or a bear market? Here are a few tips. First, look at the overall trend. If the stock market index, like the S&P 500, is consistently hitting new highs, and volume is increasing, chances are you're in a bull market. Conversely, if prices are consistently falling, and the market seems to be in a prolonged downtrend, you're probably in a bear market. Next, pay attention to economic indicators. Things like GDP growth, unemployment rates, and inflation rates will give you an idea of how the economy is doing. In a bull market, these numbers are usually favorable, whereas in a bear market, they're typically showing signs of decline. Market sentiment is another big clue. A bull market is usually characterized by optimism and a general sense that things are going well. People feel confident about investing. In a bear market, however, the mood is more pessimistic, with fear and uncertainty driving people to sell. If you're into technical analysis, indicators like MACD, Moving Average Convergence Divergence, and RSI, Relative Strength Index, can help you identify market trends. A golden cross in the MACD could indicate a bull market, while a death cross might signal the start of a bear market. Finally, keep an eye on news and events. Major policy changes, geopolitical tensions, or global financial crises can shift market sentiment quickly. Watching how these events unfold can help you gauge whether we're heading into a bull or bear market. Conclusion and call to action. So, to sum up, understanding whether we're in a bull market or a bear market is crucial for any investor. By identifying the key characteristics of each market, you can make smarter decisions and adjust your strategy accordingly. Remember, in a bull market, it's important to manage risk and not get too greedy. In a bear market, focus on finding good investment opportunities and stay patient. The markets will eventually recover, and if you're prepared, you could come out ahead. If you found this video helpful, make sure to hit the like button and leave a comment with your thoughts or questions below. Don't forget to subscribe for more financial tips and strategies. We'll see you in the next video.